wallet than yeah.
Started my recording.
I keep on seeing the food away from home and food at home, and I feel like they're going to
Yes.
meet each other at some point.
We're I know my food will be like, hey, we're exactly the same thing, and I'll be like, yes. That's how I preserve consistency. It is so it's insane right now. The market is just, it is what it is in so many respects, but it's also interesting. I don't want to give the game away, but it's going to be an interesting discussion today, because I loved your points, Albert. You're absolutely right. When the S&P drops below 4,000, I get
absolutely wild.
This is just we haven't seen these levels since over a year ago now.
Yeah, and crypto going below 30.
No, we're just.
Colin, let's kick it off and see how bad everything really is.
All right. As people are slowly hopping in. Hello, everybody. Welcome to May. Today's our monthly jobs report and recap. Right now, we're in quite the inflation crunch. We're going to be recapping the current economy and inflation numbers with Dr. Reilly White, an associate professor of finance and endowed Bank of America lecturer at the University of New Mexico. He loves answering questions, so please feel free to drop your questions into the chats, and we'll get to them when I see them. You can also drop if you're from Facebook, you can drop your questions onto the Facebook live stream, and if I see it, I will read them out loud. On to you, Dr. White.
Thank you so much, Colin, and thank you, Albert. Thank you, Albert's List. Thank you, our incredibly talented group of Wednesday evening attendees as you approach these things and are looking for your grabbing some food, interrupting your dinner plans, coming out to rock and roll and talk about some economy. I am so grateful for your time. So we have two big things we got to talk about today. Number one is the jobs report from last week, and number two is the inflation report. Now, the jobs report was pretty good, relatively speaking. The inflation report less so and more complicated. And you read the headlines itself, and there's a lot of noise associated with it. And I'm also going to discuss a little bit more detail about where we think it's going to go. And in the meantime, I want you to feel free to ask any questions that you have in the chat window here, and I'll be happy to answer as soon as I can. We had some great interaction last time, so please continue doing that. I love. When does the pain end? What a way to kick it off, Albert. We haven't even decided if the pain has begun yet. Isn't that? I know Albert's 401k jokes are top notch, and I'm going to steal them. I'm going to take them, mention it to my next class. So let's bring up this thing. So let's talk about April 2022, our jobs report. Are we crossing over inflation mountain? We are in the inflation mountains. Are we on the other side? Can we see the horizon? Or at least another lower mountain that we can ascribe to be part of in this world. And I'll explain kind of what this is. So on one hand, our headline inflation number went down from 8.5 to 8.3%. And on the surface, you're like, hey, that's good. It wasn't as we expected it. Consensus estimates were expecting it to go down to 8.1. It was up a little bit higher, but there are some sources of concern buried in this report, and I'll show you why. And one of the things is, although we've seen pressure come off durable goods, the stuff that we saw a lot of price increases in, these are durable goods, are things that people don't buy a lot of every single year, like a washer and dryer. You're not going out every couple of weeks to go buy that new washer and dryer just because maybe you collect them and you put them and kind of leave them up rusted on your front lawn and then rent them out to college students who need a place to live. But on this sense, durable goods were hit very heavily by the supply chain, and consequently, their prices shot up. We saw some price easing on that side. On the other side of it, though, we got in there and we saw some higher inflation among the service sector, and this is alarming. And the reason it's alarming is that when we look at CPI, the way that we measure inflation, service sector-based things represent about 5 times more weight than durable goods do. So it's a very, very important thing. For those with credit card debt, suggestions. That's very good, Carolyn. So obviously, sort in terms of interest rate carryover debt that you have. If you can move, if you have, for instance, debt in credit cards, and credit cards are very interesting debt instruments because it's the primary way by which Americans exhibit short-term loans and short-term debt and liquidity. The problem is the rollover interest rates on most credit cards are already prohibitively high. 10, 20, 30% is all of those between that range, it's very common. And so the interesting part about credit cards is rising rates will actually affect these least compared to all the other things you might purchase in your economy, just because rates are already pretty high. That said, do as you always do beforehand. In the first sense is figure out your debt load, try to figure out which interest, what parts of your interest-bearing debt accounts or credit cards have the highest interest rates and the highest balances. Look into, if you have a high balance card with a high interest rate, looking into transfer that balance over to a card that might have a lower interest rate, and then pay that off as soon as you can. Of course, as always good, of course, in your bottom line credit reports. One of the ways that credit scores are boosted are when you have a large amount of available credit, but you don't use it. And that's a good way to strategically increase this, especially now that we enter into this market where mortgage rates are soaring very, very high, and you might need that credit score in the future. It's just,
they are soaring.
I have so many things to talk about. Oh, there's so much news. One day I want to wake up and be like, what's the news? Reilly, there's no news. That's excellent. So Albert says, what sort of suggestion are you looking for? General rule of thumb, you should never have a credit card debt because it is expensive to maintain. Yeah, absolutely true. It is very hard, but some things happen. We always have medical expenses and debts and things and surprises, and everything happens. Life happens, and people take out credit card debt. Just be cautious, as you always are, in paying them off. So let's talk a little bit about this. April, our jobs report. So last month we called it pretty good. Now now we have something that is actually still pretty good. When we looked at the jobs report, we actually grew about 428,000 jobs, and unemployment actually remained steady at 3.6%. All of that is good. And you might look at this and say, well, superficially, I've heard a lot of people talk about how tight the labor market is. We still have a large number of openings relative to the number of unemployed people, and that is true. But what we've seen, and I'll kind of go down here later, I want you to pay attention to the wage growth number for a second. Absolutely right, Carolyn. That's an absolutely good point too, is in the chat window. So in this month, we actually saw a very well-rounded jobs report in some respects, in the sense that every sector gained some jobs, some more than others, and they were really relatively proportional to one another, which is very exciting. It's almost perfect. It's a perfectly engineered jobs report. So we had 78,000 new jobs in leisure and hospitality, which includes all things restaurants and hotels and such things. 59,000 in educational services. And you're like, educational services? This is very interesting. And so a lot of that involves both local and state educational services for universities, as well as individual institutions in schools, college, teachers, all those things. Hiring 55,000 for manufacturing. Manufacturing has been particularly robust the last few months. We're seeing a lot of companies look and kind of say, okay, our supply chain's broken. What can we make in the States? And they are doing that. The downside is very few, relatively speaking, Americans are employed strictly in manufacturing as a proportion of the economy. But we are seeing growth here, and that is a good thing. And also the strength of the dollar relative, the dollar could be much, much weaker. Usually in times of weak dollars, that means our exports, what we export to other countries, is cheaper for other countries to buy. So consequently, it benefits us. Our exports, we expect higher exports when the dollar is weak, but the dollar strength has been hanging in there, and relatively speaking, and we had another 52,000 in transportation and warehousing jobs. And let me shrink that here so you can kind of grasp it. Transportation jobs are part of that other segment, which is very interesting. That has been very robust in a sense that we now employ much more people in this sector than we did prior to the pandemic. And the reason is, of course, is supply chains, et cetera, transportation, getting things places has become an incredibly high in demand area. When we dive deeper into the transportation sector, one thing we saw in the last month is the cost of transportation, one of the highest increases that we saw in our individual subsector based economic we look at all the sectors in the economy, and we're looking at price increases in CPI, transportation costs increase dramatically, which is consistent with a industry that needs people and it has structural supply chain issues. So it makes sense this is still happening. Okay. Now, the other thing is, and here's where we're going to kind of divert from sort of these various narratives we've been hearing about certain things, wage growth. So wage growth is indeed, in the long run, a power of inflation. You can't, people don't buy stuff unless they make more money. So paying people more money can generate long-term inflation, but this doesn't seem to be what's happening right now. And here's why. Right now, wage growth is about 5.5%. Ooh, we have a hand raise. 1 second, Dahlia. Wage growth stands at 5.5% for the year. It is down slightly from 5.6%. This is really interesting. With higher, sort of a 30,000 foot view, we would anticipate that higher inflation, and if it was indeed a wage growth oriented inflation, we would be seeing more wage growth at this time. Wage growth has slowed down, if anything, month to month. And the problem is what that means is what are we going to do? So if we're at 5.5% for the year, we're still losing money on a month-to-month basis in real terms from people's paychecks, and it doesn't seem like it's powering this. And so if inflation isn't powered by wage growth, what's doing it? It's supply chain issues, it's profits, other things. I'm going to show you a couple slides down what I mean by that. Dahlia, question. Oh, cool. I see your hand raised. Oh. Okay.
Hi, Dahlia. You're muted.
Oh, that's okay. Accidental hand raising is perfectly fine.
That's perfectly fine. Okay. Let's go with do you see the question and answer box? If you have a question, please type it in there and we'll get to it.
Yes, I will do the best I can. That's good. Thank you. Thank you, Colin. This is good. Question and answer box. Type in your questions. We got it. That's okay. Sorry to put you on the spot, Dahlia. That happens all the time. My life is a series of Zoom foibles, so much so that here I am stumbling into this fantastic Bay Area conversation. So wage growth is good, but it's not high enough to catch up with inflation. And it means that in other sense, there are other causes that behind inflation other than wages. Wages, though, if they persisted over the long term, it would be something we would look at, but let's go in a little bit deeper. So other things to look at, labor force participation, which is very important. The amount of workers who are the amount of our physical labor force who are working is about 62.2, down from 62.4. Not a good sign that it went down, but it's been kind of steady within plus or minus 0.2% for the last few months. So overall, the employment change by industry, if we look back between March and April of 2022, we saw growth across the board. Construction's a little bit lagging. Construction's been hit with supply chain concerns, but information sector grew jobs, government, wholesale trade, retail, of even financial activities. It was a very uniformly pretty good job market. Now, some things to note about this job market when we dive in a little bit deeper. The first is how much of this is a non-government payroll-based recovery, meaning that if we look at the private sector, they recovered pretty well. This is what we see as just a labor force dynamic in general. The private sector fires quicker and they hire quicker. The public sector fires slower and they hire much slower. And what's interesting about the public sector is that their hiring has been slow even for the public sector. So right now, even though we're just a little bit, a smidgen below our total payroll size that we were prior to the pandemic in February 2020 and the before times, right now, government is still about 3.5% below. It's still dragging in a significant way. And this is very interesting. And we know, for instance, that, I had to do this. I was doing some consulting for a city, and I had to look into the broad question of how inflation and government and sort of recessionary environments, but how inflation affects municipalities. And I had to dig up these papers from 40 years ago. I blew off the dust, and I was kind of just like looking at these papers of these things because it's been so long since we've had inflation. And it's very interesting. And so inflation, of course, raises costs for the city. It raises employer costs, but it also generates more revenue in the form of sales tax revenue, other things where people spend money and bring it into a place basis. So sometimes governments can actually generate money in inflationary environments because taxes are usually exerted from a percentage of income. But on the other hand, other things don't work that way. For instance, property taxes in many states or municipalities and locations are capped on how much they can increase in a given year based on taxable value. So even if your real estate goes up 20%, you might only be able to recognize as a municipality a 5 or 3% increase annually, depending on your jurisdiction. And so there's a lot of noise in this area, and that's very interesting. And so because of that noise in general, you're looking at a lot of people, especially in government, who are burdened with doing the labor that they were doing beforehand, plus somebody else's who was laid off. And we just don't see a significant impact on hiring. It's also true on the other side of this, even though there is a lot of open government jobs in the city that I've been working with, they still have about 1/3 of their workers are unfilled right now. And why is that? And one of the big reasons is as wage expectations increase, private sectors can the private sector can usually respond quicker. They can offer more incentives, other things. Governments are often they often don't have the ability to be that flexible. Many of their sort of the structured way at which compensation happens at the municipal or government level is prohibitive of large wage increases for new jobs. And then you're running into all these other questions about people who have been there for a while. And so it becomes a really substantial issue. Now, when we go back on the left side of this chart on the left, we have employment change by industry since February 2020. We're still down almost 1.5 million workers in leisure and hospitality. We're still down 700,000 government workers, 400,000 in education, and 278,000 in other services. Where have workers gone? Professional and business services, transportation, and warehousing. And if you happen to be in a professional and business service position in a transportation and warehousing company, you've got it golden right now, which is excellent. So any other questions? This is what this is. It's the National Association of Professional and Business Service people in transportation and warehousing. It's a very robust market for this particular subsector of the economy. So, wow. I know. What are we gonna do? Questions? What do you guys think? A lot of things at once. I know it's Wednesday, and we're rocking and rolling, but had meetings for the last 11 hours. This is the most exciting part of my day. This is super great. So ask questions if you have anything. No such thing as a dumb question. And we'll kind of get into this a little bit further. So let's dive down into the Bay Area, because a lot of things I'm going to talk about in the next few panels are Bay Area specific. And so when we look at national economic data and compare that to regional or metropolitan economic data, there's a lag there, and the lag is usually about a month or so, give or take. So right now we only have March data for the Bay Area. Last time we had February. So the March data though was very impressive for the Bay Area. Oh, thank you so much, Carolyn. You are so kind. My favorite. I have favorite attendees. You guys are so great. So when we think about the San Francisco area, especially in the Bay Area, we're seeing a consistent increase in the labor force. People who were offline are coming back online. They added about 17,000 more people in the labor force. And in addition, there were 29,000 more people that were employed. Since there are more people who got jobs than have entered the labor force in total, you saw the unemployment rate drop. And the unemployment rate dropped to 2.9% in preliminary numbers in March. That's very good. And it's not meant to be frustrating as well. I'm conscious as well. This is a job searching site. So if you're in a situation where you haven't found that job yet, or might be looking at this is not aimed at you. Many things are individual cases, and your own individual experience might differ from the aggregate of the overall Bay Area economy. But this is actually really good. 2.9% is about as low as we've seen. The only time we've seen that lower in the Bay Area was that kind of window between 2017 and 2020, a golden era of sorts, where we dropped to about 2.6% in the Bay Area. So the total number of unemployed people have dropped to 74,000. This is very good. Now, on the other side, where did we see that wage growth, and where did we see, I'm sorry, not wage growth, where did we see that employment growth? And we saw sort of a generalized, a lot of sectors added a little bit. We saw a significant bump in professional and business services, about 5,000 more jobs here. And I know it's an overarching sector, but it refers to anything that's not easily classifiable that would otherwise be professional. Probably falls in that job. It is a sizable sector. It makes up about 1/5 of the overall workforce of the Bay Area. And we saw 5,000 new jobs in this area, which is really significant and statistical from our area, statistically significant. Leisure and hospitality, which has been lagging, of course, popped right back up to where we saw, we kind of hit about 219,600 workers in December. It dropped back in January and February as people were laid off, post holidays, post vacations, people leaving Cali, going somewhere else for their holiday season. Coming back in March, we saw slightly more workers employed there, which is good. And on the other hand, other services also did well. Government's still been relatively languishing. There are fewer workers in government now than there were back in November. And information sector as well has been relatively flat, about 143,000. So these are very interesting numbers. Now, I want to kind of blow up two charts here that are very important. Well, the first one I'll start with is unemployment. Unemployment is, this is a good sense of unemployment over time to show you how, I just made this much worse to read. Let's see, what am I doing here? Unemployment since 2012, over the last 10 years. It was before sort of the 2008 recession. There was this idea that unemployment, it would be very rare to get unemployment below about 5%. And what happened is that most of the country went below 5%, 2014, 15, 16, 17, 18, 19. The pandemic happens, unemployment shoots up in the double digits before dropping back down, but this recovery has been incredibly swift. Now, on the other side, under the non-unemployment side, you have something that's very real, and you're experiencing, you are feeling, experiencing, and dealing with inflation in ways that you haven't before. But I want to point out something very interesting. If we look at the consumer price index, not nationally, but just for the Bay Area, and to give you a sense of this, the Bay Area Consumer Price Index, and this will sound very strange, the annual rate of inflation in the Bay Area is lower than the national rate. It's about 5% in the Bay Area versus about a little bit more than 8% nationally. And you're like, how can this be, Reilly? What sort of, so think about the way that the CPI works, the Consumer Price Index works. It is a representative basket of goods full of stuff that the average person will buy. The CPIU is the average urban consumer. What do they buy? And of course, you're like, well, I don't buy this. I spend 80% of my income on my residence. This is not even adjusted rationally, and it is a general viewpoint. But notice the slope of this line since 2012, and the slope is fairly consistent. So inflation in the Bay Area exceeded most areas of the country in 13, 14, 2015, 2016, 2017, 2018. It had a little blip in 2020 where it went down a little bit due to the decline in economic activity from the measuring year. And then since it's gone up, remarkably stable slope of this chart, I have to say, relatively speaking. And that's very interesting. And one of the reasons is one of the big component parts of inflation is shelter. And we'll get into what that is. Rent and housing in other places. Now, of all the things you can argue about price increases in the Bay Area right now, shelter has been relatively consistent, low growth, and even declining in certain peninsula communities. And this is slightly, if you're talking about 1.25 versus 1.24 million, yes. So in this sense, this is offsetting some of the increases we see in other places. Case in point, let's compare the Bay Area to Phoenix, right? Let's say you got to Phoenix. Everyone knows somebody who moved to Phoenix. And one place, you might have moved to Phoenix. You might have moved from Phoenix. And you're like, why is this so expensive? And you're like, I can purchase 5 houses here. But in Phoenix versus San Francisco, you have two vastly different slope trajectories here. Phoenix had incredibly low pre-pandemic inflation, like the rest of the country. We're talking 1%, 2% per year. Look at the slope from 2020 to 2021. It is significantly steeper by a factor. And the driving factor of that steepness is the increase in the price of real estate, which is in the double digits for most of the country, outside, uniquely, of a few urban enclaves that are already incredibly expensive, one of which is the Bay Area. Is that so? I know.
Housing's fault.
Yes, everything is housing's fault. This is my point. That's exactly
Everything's
right.
housing fault.
Right. That's right. That's why I was in a conversation, actually. That was my I had a back and forth with Sean, who's gratefully on this side over email in the last few weeks. He sent me some very good stuff, and I'm going to talk about that in a couple of slides. But a shout out to Sean too. And I was using example of, this is really interesting. It's a zoning question, it's a realty question, and San Francisco has been this. You've had these various elections happening where you're looking at YIMBYs versus NIMBYs and everyone else in between, and you have a very interesting, you have a very highly politicized a dynamic involving real estate. And so, and it becomes an important aspect in this. And so first, when we think about this, let's think about, is inflation about wages? So one thing we can look at is let's think about this, and this is from the Economic Policy Institute. So in the long run, inflation is often about wages. To sustain inflation, you need to pay people more money, or people don't buy your products, so you have to drop the price of the product. So, or you have a recession, and then you have stagflation, and then that's another thing. That's more of a worry than I had about 3 months ago. But normal and recent contributions to growth in unit prices in the non-financial corporate sector. Where are we seeing the increases? We look at 2020, which is in dark, between the second quarter and the fourth quarter of the second quarter of 2020 to the fourth quarter of 2021, which is in the dark blue. And then the 1979 to 2019 average. So profits, non-labor input costs from, for instance, a lot of different locations, all the supply chain issues we've seen, commodity price increases, have strongly outstripped the growth we've seen in unit labor costs, which are often the things like paying people more money that we look at. So it's not really paying people more money, it's supply chain issues. And it's hard though. And I know a lot of people, I don't want to hesitate too much and be like, well, it's profits, but it's significant in the sense that it is being passed on to consumers. But there is a limit to do this. There is a certain elasticity, inability for the market to respond to supply and demand changes in a reasonable way. And another way to look at this as well in nominal wage growth. And the thing is to look at this is we think about a shock, and certain sectors have felt this more than others. In leisure and hospitality, we saw wage growth shoot up around 13% year on year. In other sectors, the gain was much lower. Right now across the country, again, we ended at about 5.5% between April of this year in April of last year. That does not in itself a recession make. And as you know, wage growth, while it is better than it used to be, year over year change, which is kind of the darkest colored line in this, very tough to read, of course, in this chart, but we're just trying to, and a shout out to the Economic Policy Institute for doing something more eloquently than I can provide. And you end up with wage growth that doesn't look, since 2020 at least, incredibly impressive, and it's certainly not reaching a level that would sustain or cause greater inflation in the long run. So mixed bag. Wage growth isn't slow, it's growing. It's not enough to sustain inflation in the long run, but it's happening. And but the downside is it's not going up, it's certainly not accelerating, and most people have argued that it's flattening or even potentially dipping a bit in where it is, and that's very important to note. So why at the same time do we have this duality where we have a lot of unemployed people still? We have a market that is with a lot of available jobs, yet wage growth, despite the apparent tightness of the labor market, wage growth doesn't seem to be showing that in a very significant way. And we see a little bit of that. And I guess the short answer to this is we're looking at a complex sector by sector thing where wage growth is often very low in sectors that have, or lower in sectors that were not adversely affected in the pandemic. Wages have come up in sectors like leisure and hospitality that were affected by the pandemic, but also at the same time, these companies have restructured their labor force in meaningful ways. And I think that we're going to see a continuation of this. Meaningful ways that have consolidated positions. They're trying to do more with less. And that's a very interesting thing. But it's sector by sector. And we're not seeing this in a continuous basis. And certainly from other standpoints, there are some weak spots here. But this is something that I think is very interesting and a very important thing for you to observe as you go kind of forward in the next few months. And I'd be interested to see how this, if wage growth kind of caps out at 5% or we see a little bit of push. And I got some more inflation slides to suggest that, well, we're going to be in for an interesting road. I'll take a pause there for a second. Questions, and Colin's always got some awesome up his sleeve. So
Can we go back to the previous slide? Because
yes,
I think this shouldn't be glossed over. We have record inflation
Too
at
much
a
for us.
time when corporate profits are 5 times what they were in the previous 3 decades. So are corporate profits driving inflation?
Oh, think of this. That's a really good question. So this is the thing. So all these numbers should add up to 100, right? So if we look at what contributes to the growth in prices, on average, most of price growth should be associated with labor costs in this country. If we go back to 1979 and 2019, you could say, well, Reilly, I'm not going back to the industrial era. There's nothing to suggest, like we're not going back to the 1800s. We can argue that, yes, we were more labor driven in certain ways in the 80s than we were in the 2020s, but not in this level. 62% of that price increase from 1979 to 2019 was derived from unit labor costs. This one only about 8%, very little actually. Corporate profits in non-unit labor costs, supply chains and profits are the source of where we're seeing that inflation in terms of how it's passed on to unit price growth in non-financial corporate sectors currently. From the data comes from the National Income and Product Accounts, the NIPA of the Bureau of Economic Analysis, the BEA, which is where we get most of our data.
Okay.
So yes, so you're right. You're absolutely right.
Yeah. So
no glossing. I should not gloss.
There's a lot to dig in there.
Yeah. There's too much gloss.
There's a lot to dig in there.
Yeah. So to your point, to your bottom line, historically speaking, corporate profits indeed represent 5 times the share of inflation, of the inflation measure we have, than they did on average between 1979 and 2019.
Okay.
But inflation was also really low for about 35 of those years.
That's true.
But that's not an excuse. It's not. I can't compare us to the 1981 economy because that's a completely different thing.
My second question, I guess, is the flatlining of wage growth have to do with the fundamental shift towards remote work? Where companies may be realizing, hey, the infrastructure is significantly supporting remote work and offshoring the labor force. So instead of, for example, hiring someone who's expensive in the Bay Area, they would rather just hire the same person in, let's say, rural Alabama who can do the same job for half the price. And then this is contributing to this, I guess, I wouldn't say artificial suppression, but a change in how the workforce is adapting to new technology.
That is a fantastic question, Colin. And you're absolutely right. So the short answer is yes, but I don't know to what extent. And then there are other factors at play as well. So for instance, when we look at, think of the way you're compensated when you engage in negotiations to be hired by a company. Compensation is part of that. Lifestyle is another factor as well. Companies can likewise lever your ability to work from home or work part-time, let's say work 2 days outside of the office, knowing that you would accept a job for slightly lower pay that offered you more flexibility, while at the same time not requiring you to come into the office. Like everything is paid for. And the problem is if, and I think that there's a lot of, using this as an example, there's a lot of things that are happening at this level where companies are shifting to their bottom lines in meaningful ways and away from these labor force increases, because one, to your point, they're outsourcing in other places that are cheaper and more affordable. Number two, to your point, it's part of the overall contractual arrangement between the individual and the corporation. On one hand, we're seeing a lot of companies look at flexibility as a useful tool. On the other hand, they know exactly what they're doing and they know that they can adjust your compensation accordingly. And then Carolyn points out, it looks like corporations have been hugely increasing their profits and blaming it on inflation, supply chain issues, and the pandemic. It's very interesting. It's certainly, I know, I'm always like, well, this is the chart. It's the chart. It is from the data. You check it out from NIPA, Bureau of Economic Analysis. But take a look at this and make your own assessments and judgment, of course. But yes, profits are very high and relative to historical standards too. And that's an expectation that investors have. There's a huge influx of equity investment after the pandemic, and even post the Great Recession, we saw an influx of people buying stocks. Stock performance is based on the present stock price, is nothing more than really a present value of all the future profits a firm makes. So firms, to deliver strong returns to their investors, seek profitable outcomes. And this is a factor of this world, of this profit-based world. And it also contributes, of course, to other things, inequality and aspects which have negative externalities in a very meaningful way. So Carolyn, that's not incorrect, actually. It's very good. And it's true. And so you have the composition of inflation has yet to shift into labor costs. It's possible it might still. We are early in the system. Usually we would expect, if I was ignoring if I was looking at these three factors and I said which would contribute most early in a shock-based inflationary environment like we've seen, I would bet non-labor input costs first, and profits outstrip that. And that's a fascinating thing. Fascinating thing.
Earlier, you said that the short answer is yes to my question about
yes,
companies reorganizing themselves around remote work. Do we expect that to become a trend in the future? And will that have a hugely negative impact on, I guess, Bay Area job seekers who are now increasingly seeing themselves competing on a national and maybe international jobs market?
So I have a positive and an optimistic and a pessimistic answer to that question. The first thing is because you're in the Bay Area in technology, you have already been competing internationally with workers, period, right?
Mm-hmm.
You develop these skills, and usually what we see with sort of this with certain areas of the economy or different regions where we have a high amount of inputs in certain sectors. For instance, people come to New York City to be in the financial sector. People come to the Bay Area to be in technology or to have startups in other areas. People go to Austin when they get tired of the Bay Area. And when you have these things in between, you end up with a labor force that is structurally already built around providing the best possible labor for this area. Now, when we think about that, optimistically, you've already been competing at a global level for these things. Now, but to your point, and this is the key point, the companies have, I mean, it's a mixed bag right now. Are companies all going to move out of the Bay Area? Are they going to have a headquarters here still in the Bay Area, but then they're going to hire workers from Alabama or Tennessee or Iowa or North Dakota or other places where they might feel like they can afford less fewer workers? And that's a very good question. And right now, unfortunately, so there's a few aspects. The labor force itself, one of the things that differs from how economists see the world and how people behave is the way that labor forces move around. For instance, and a good case of this is the European Union, right? We knew back when the European Union became a common currency area a generation ago that the idea was, of course, this would have a long-term leveling effect on, say, the economy of Greece and the economy of Germany, because Germans would move economic activity to Greece, which was cheaper. Greece would, Greek workers could move to Germany without labor restrictions. But in reality, we know that there are costs to those things. There are cultural costs, language costs. There's the cost of moving. The labor force isn't as movable as we otherwise thought it would be. And so, although in this sense, you could argue and say, yes, maybe there is an outstanding programmer in rural North Dakota that would be a fantastic fit to do half the work of somebody here. But at the same time, the level of specialized work in a competitive environment that you've all developed working in the Bay Area isn't going to be replicated in Fargo. And it's not going to be replicated in another place of the country. And you've been exposed to a culture and a community of technologists that have helped you in a way advance to beyond where you would be in other places. And so they're still going to look for labor in a flexible way, but they're going to find most of their labor here. Sean Reilly, bam, Regional Innovation Systems by Michael Porter. That's actually yes, boom goes the dynamite. Porter, you may know Porter from his 5 Forces and other things. You may have taken, if you took business school classes back in the old days. That's a great inlay. And then I'll get back to Carolyn's question too. So in short, yes, it is going to be a factor, but The thing is here you've built a system and a reinforcing system of people with a highly specific set of skills that they'll find here. Now, on the other hand, you have a separate question, which is work time flexibility, work from home, et cetera, et cetera. This will have effects in urban dynamics in terms of real estate prices, other things. The decisions people make when they have to come into work 2 or 3 times a week are different than if they work for 5 days a week. You know, you might want to live, you might feel like you have to live in Redwood City if you're commuting out to your technology startup, which is 20 minutes away, and you have these other things, you don't deal with traffic. You can live someplace cheaper if you want to. You can live out in Antioch or something, and come in if you're only coming in twice a week. Those decisions will change real estate dynamics in certain ways, but it's we're going to see how much of this is. The thing is the magnitude. And Carolyn points out housing stock in many areas of the country is being bought up by large financial entities. That's true. The investment of housing stock is a factor, distorting the whole housing market for buyer and renters. What to do? I like that. What to do? What to do? Oh gosh. So this is a really good question. So when you think about asset prices in general, lower rates stimulate people buying asset prices. Assets include things like real estate. They include equity. They include anything that people can own and trade. So real estate is one very important asset class that's picked up by a lot of investors. So back up for a second and think of all the stuff happening right now in sort of the way that we look at, let's say you're running a very large fund. And I'll say this because we have, for instance, I have university endowments, we have other things that we serve and work on in certain ways. So when you have like a very large institutional fund commanding hundreds of millions or even billions of dollars, you're looking for places to generate yield, to generate returns. And so you have a limited number of places where you can put that in. And that lines us up very neatly for the next slide, Carolyn, too. So a lot of activity has been put in places when interest rates were kept really, really low. People wanted to earn more than 1% or 0% on their money. They put a lot of money in the stock market. They put a lot of money into private equity, and they put a lot of money into real estate. And in just talking about real estate at this moment, we've seen sort of the investment in real estate, which has existed in other countries for some time, as well as the United States. The number of people holding investment real estate has increased by a significant amount. So what does that mean for buyers and renters? On one hand, the interesting part about this, what factor, and I guess one question you could ask, and I don't have the data on this now, but maybe I can find it for the next time, is the question to ask would be how many, or how can we separate the effects of the market right now versus the overall and the market increases in real estate prices from what effect did investors have on real estate prices in the last couple of years? It is a significant effect, but we also had the effect of historically low 30-year mortgage rates, which bottomed out in basically winter of last year, and then now have soared above the 5% level, making your dreams of owning property, which you might have been reasonably close to doing if you're not currently in a position, just fly out the window for many people. And this is not going to be a permanent state of affairs, but it is a significant one. When we have higher interest rates, that obviously reduces the purchasing power of investors and buyers. And it also can result in a certain situation. Investors do want a return on their money. So if they are investing in real estate, which they've acquired through very low interest loans, they do want to sell that in a fixed amount of time. It is expensive to carry real estate without, say, a renter. It's expensive to hold on to real estate for a long run. And as rates increase, you're looking at fewer buyers on a certain end. You're disincentivizing buyers on one end. And then consequently, the price will have to go down to adjust for that. And so both the real estate market in response to higher rates is in for kind of a ride in the next thing. Carolyn, you gotta keep old white guys there. This is fun, Megan. This is very funny. Megan, Apple forcing people into office 3 days a week. Meanwhile, they don't have places for these people to sit and work efficiently. I know. Come into the office, and by the way, share your desk with your least favorite coworker. Carolyn, this is right. Oh my gosh, this is great. Look at this. Own homes, here how much changed. This is very interesting. Megan dropping some very useful links into the chat. Thank you so much, Megan.
Thank you so much
for keeping that. This is the activity that I love to see in these conversations, like so much. It is tricky. Yeah, I'm sorry. A lot of things, so many things.
To kind of summarize my earlier question. So you're saying that yes, there will be a trend towards exploring remote work for companies, and
Yes.
from there, there might be like a wage suppression, but Bay Area job seekers have the advantage of culture.
Bay Area job seekers are part of a regionally reinforcing economy, where you have the reason that there's a lot of reasons why firms with certain characteristics clustered together in certain areas. And one of the reasons is labor and the availability of labor for people who do it. Like right now, a Facebook programmer, if you're a programmer at Facebook, you can go over to Google, you can go to other places. You have a set of skills which people, even worldwide, dipping into a pool from anybody across the country would not have, and across the world would not have, because you've already entered and competed in that market. And so that is the onus to this, and sort of the bottom line is the workers that they're looking for aren't really in Alabama, unless, and it's more likely the Alabama workers have come already to the Bay Area.
Okay.
Yeah.
Okay, interesting. Yeah. I will ruminate on this as you continue on your slides.
Ruminate. This is so good. All right, thank you. All right. So anyway, this is my shout out to Sean's slide. Thank you, Sean. Sean put out a very interesting and very notable website called layoffs.fyi, which I didn't know about. You probably all knew about it. Maybe it's all over Albert's list. Maybe it's just something to follow. I found it genuinely fascinating for the data it has. And then it gave me a bunch of research paper ideas in reading through it. But anyway, just to give you a glimpse of this, and one way to look at, say, economic health in certain things and overarching, Sean and I had a very active and very engaged discussion about his experience in private equity and sort of where private equity itself is going. Why do we care about private equity so much? Why is this always a thing? Because it's we had a very sustained period of very low interest rates, and investors were looking for ways to generate yields. And so investors who are normally very risk averse, generally speaking, people like big returns but no risk, and obviously you have to meet them in the middle at some point. The economy around private equity or investments in privately held companies as opposed to publicly held companies has drastically expanded in the last 15 years in particular. So for instance, this became such a big issue that when we put out an RFP for a money manager to run our entire university foundation, we had like 14 or 15 replies. And where the difference was 10 years ago, private equity would not have been included as one of those asset classes. The suggestions from all 15 ranged from 15% private equity to 45% private equity. And the reasons is that it represents very significant promised returns for institutions with a lot of money. And the way that they've sold this or presented this is that they often come with, because of the nature of the contracts themselves that are developed in ways to generate certain guaranteed returns over a period of time, they were considered very relatively safe. And they still are. And the thing is that everything is safe until it's not, right? But it's very interesting to point out that as rates come up in general, we're seeing kind of less of an incentive to go off and invest in private equity. And so one of the things is that companies that might have been able to get money from anywhere in July of 2021 are now finding it more difficult to raise funds, and not just Series A stuff. If you're running in consequential series and other things, and Sean made a good point, and I want to shout out to this, the rate at which these firms are burning cash is going to become more important now that cash itself is more dear than it was when it was free. And it's dear because the rates around cash are much higher than they were. And as the Fed increases rates as well, at the same time, we're seeing high inflation and higher expected returns in certain aspects. That takes appetite, that reduces investors' appetites for certain risks. So it's very interesting. And layoffs, which were high right after the pandemic, and then very, very low as a bunch of startups began, are now starting to return. We're seeing increases in layoffs. And this number is so interesting that I want to keep watching this over the next few months to see how the private equity sector in particular shakes out in the next couple of years in response to high rates. It is a challenge that we don't have data on. So like when I was a banker in 2007, and I was looking at historical default data for mortgages, I had nothing in my data set that included the series of events that led to 2008. So like me and the rest of all the other banks in the country, we didn't really have a comprehensive answer. That's right. Ecosystem question. Carolyn, a very good point. Silicon Valley is a culture and ecosystem that provides huge value to all who participate in it. Part of why people come here from all over the world. Absolutely true. Absolutely true. Don't forget, don't give up on the California mystique, in the Bay Area in particular. There's a collection of smart people who can visit. And then first they come as tourists and then they stay. Now, inflation. So this is the question. So I'm going to go back into inflation here. Does anyone have any other questions about stuff before we step into this muddy waters of inflation and try to get our hands around this? Because there's a couple angles I want to kind of talk about in this and kind of want to do it. So Carol, down at the bottom line, is this true? Is it true that it does come this way and you're looking at this? And certainly if you look at aggregate data, you've been seeing numbers about how people are at least moving out from the peninsula to other suburbs and even out of state in reflection on certain things. And the question is the makeup of those workers and who is there within the respects of certain sectors, particularly around the areas that San Francisco and the Bay Area in general have specialized in. It is true. And it is true that people who are seeking jobs, it's a reason that my students, regardless of the universities I've taught in their backgrounds, have, if they have technical aptitude, and whether or not they were capable of doing it or not, one of the first places, the number 1, 2, 3 companies on their list in the last 5 years have been Bay Area companies, and they've tried to seek out they still have tried to seek out living and working in the Bay Area, and that's really interesting. And it is very interesting, and maybe that is the cycle. And that's true. Absolutely right. Absolutely right. Tech value prop is perhaps outstanding. All else, maybe not. Exactly. That's not everything. You won't do everything right all the time in the Bay Area. You want to attract workers from everywhere. There is also research to suggest that a outstanding sector in one area does attract better workers in at least sectors that are adjacent or approximate to it, or at least up and down laterally within the supply chain. But in general, it's true. Now, inflation. Inflation is a beast of a problem, and right now I want to underestimate it. We know that last month we had 8.5% annualized rate. Now it's down to 8.3%. We expected 8.1. Okay. So what does this mean, and what do we do with this? So right now, if we look at seasonally adjusted changes from the preceding month, and we look at all of our different sectors and where we're seeing inflation happen, in the last month, in April, the sectors that saw the most inflation were transportation services, 3.1% in a single month. Piped gas service, part of utilities, energy services were up 3.1%. And at the same time, we saw declines in gas prices. Why did we see declines in gas prices? Didn't I just read in the news we hit new prices? In March, we had the Russian invasion of the Ukraine. That shut up the price of gas, which we recognized in April. It's since come down a little bit, but then it went up further in May in response to sort of a seasonal cycle of gas price increases. People, as we approach Memorial Day, the demand for oil increases to summer levels, and we expect elevated levels the rest of the summer. But we had some other interesting things. Apparel, used cars and trucks dropped in price. Used cars and trucks are interesting. They didn't drop by as much as they dropped the previous month, but they're still going down a little bit. That's good news, right? Cars and trucks are a durable good. We saw slight declines in some other sectors and kind of flatlined on certain medical care services and other things as well. But literally, we're talking about, anytime when you see a month-on-month increase in a sector of 1% or more, that is significant. So things like new vehicles still going up 1% in price over a month. Things like energy services in general going up 1%. Food at home, 1%, to get back to Albert's fundamental point. So it's a very interesting question. Let's break this down a bit further. So let's talk about shelter inflation, and a shout out to Jason Furman as well for providing charts and doing other things here. But CPI shelter inflation, if we look at the 12-month change in shelter prices, it is significant. Month on month in our annual rate, our 12-month change has been sizable, and it has continued to increase over the last year. So that orange line, that 12-month change, which is kind of that trailing 12 months where we look at real estate price increases, have increased dramatically and are now above 5% year on year. That's very significant. It is it is one of the most significant line items in CPI. And then if we strip away two volatile areas, we strip away food and we strip away energy costs. And you're like, what else is there? We get something called core CPI. And what makes up core CPI is important because it tells you sort of where the economy is going. New and used vehicles helped drag down inflation a little bit last month. We saw some negative values there. However, what we're looking at in aggregate is we're still seeing a sizable amount of pandemic affected services. Even as a percentage of core CPI, it is still really, really high in April. And this is very interesting. If we look at other ways behind this, if we look at this as well, and this is a couple of charts from Bloomberg, you can see that energy contributions in general, used car, food contributions to this, all of these have increased drastically over the last year. Used cars and trucks have been riding that wave in a red line and they've gone down a bit, but in response, they've spread to other parts of the economy, and that's one of the most alarming parts. And so Carolyn says, seemingly the petroleum industry always punishes California. Gas prices are always much higher here. We have the home of EVs, solar, lower emission regs, all that stuff they don't like. And the only way not to be punished by the gas industry is to go electric vehicles. That is true, though. I mean, California does have one of the highest, gas taxes, other things. If we look at gas taxes across the country, commodity prices are very interesting things. In New Mexico, it's the second biggest oil producing state in the country, and it's not the cheapest price for gasoline, but it is shipped. You mine it, you take it out of the ground, you ship it somewhere else, you refine it, comes back in gasoline, it becomes priced as a global commodity, and you add taxes onto it to incentivize certain things. And it's very interesting. And components of core CPI, now another way to look at this, and Bloomberg had a nice little neater chart here, is to note that energy costs, which have gone up substantially and are very volatile, the green lines, I want you to pay attention to the blue lines, which is service sector. So initially, when we talked about inflation, we talked about goods, which are red. The bigger the red pieces, the more significant goods prices led to inflation. That's what we saw over the last year. However, services are much more, this is much more challenging. We've been talking about this for a while, that inflation will spread into services. The service sector economy dwarfs all other component parts of the economy. And it is seeing inflation in this area will have more effects on your day-to-day life. So shifting from goods to services. Another way to look at this, we see price relief in durable goods. Inflation is now creeping into services. And this is important because it matters 5 times more in calculating what the inflation actually is. So core services start going up, durable goods prices come down. And the question is how do we get our hands around core services? And the short answer to this is it doesn't, there isn't a short answer. The Fed is going to raise short-term interest rates. They have enough now. They have a strong job market number, and they have enough they just raised rates by 0.5 percentage point in the last meeting. They have enough wherewithal and sort of they have an onus to increase it further, and often by a significant amount, and that's going to increase short-term rates. The Fed determines one rate, which is overnight lending rates to large banks, but this has a cascading effect on the rest of the economy. So when they raise rates, they're likely going to increase. That will have the effect of increasing the cost of borrowing, increasing the cost of goods. It will also lower consumer demand. Consumer demand and corporate demand for services, if that is successfully lowered, that will reduce inflation. But if it's lowered too much, you end up with a recession. So we have a very fine balance to walk upon this year, a very fine balance. And then to tell you how just unprecedented we are, I was trying to figure out a way to visualize this for you. So when we think about inflation and we compare it to 10-year bond yields, what am I saying? So the US, when the US spends more money than it has, we issue bonds, and investors buy bonds, other countries buy US bonds, everybody buys bonds. So US core bond yields are kind of a way to say, implied within the bond yield is a future expectation of inflation rates. Normally, CPI and the 10-year bond yields agree kind of in a reasonable association way, something where as a whimsical academic, I can draw a line through them using an ordinary, like a least squares model, and create some kind of relationship and then write a little paper about it. In the last year, at the bottom of this chart, you have how high CPI is and how low the 10-year bond is. And the 10-year bond is low because investors are expecting inflation will drop 10 years from now. They don't expect inflation is going to be a big deal 10 years from now, or that rate would be much higher. And we would expect rates, if we were consistent with this, our April numbers coming in at CPI here at 6% or so, we would be up around 10-year yields around 7.5% or 8%. We're not seeing that right now. We're seeing rates around 3%, which implies that the market still believes inflation, while not transitory, isn't going to last a decade. Is the market right? Often not. But it is telling that at least, this is like the smartest people in San Francisco discussing what the smartest people in New York think. This is really interesting. What's going to happen? Good, Sean. This does a good job explaining fuel price inflation we've been seeing with the part of California's challenge. Oh, good. Another YouTube link from Sean. Thank you, Sean. That's great. It's so painful because I want to click on all these links, but it's going to screw up my screen sharing.
Can we go back to slide number 9?
Yes. I know you've got questions in there, Colin. You've got thoughts. Drop them.
So we went from 8.5 to 8.3, but this isn't a, I don't think the, I guess one of the things I was thinking of when I read about it today, and people were celebrating that it didn't go higher. It's not true. That this is a speed. This is an acceleration chart. We're still accelerating. We're just not accelerating as fast as we were, which is still bad because we're still traveling really fast, right?
That's right. That's right. So I like your perspective on that, Colin. That's really good.
Because I didn't know what there was to celebrate. We haven't really slowed down.
No, things aren't getting cheaper
in 2 years, right?
So the problem is, that's fun. I would compare it to, that's actually true. I like your acceleration example. It's like if I'm speeding down the highway and I'm going faster and faster, there's a brick wall in front of me, and then suddenly I just ease off the gas a little bit. I'm still I'm still increasing in speed. I'm still increasing in velocity, and but I'm not. I've given myself a 100th of a second more life before I crash the brick wall. This is a terrible analogy. But one thing is this, to your point, it is our fear, I guess, was, or an expectation was, it could be worse if we had double-digit inflation. The psychological effect of that would be significant. The downside is that we expect, is this going to result in inflation gradually falling in a very even way down to 3 or 2%, which is what the Fed views as a best case scenario over the next 2 years? Or is inflation going to be shifting, and we're in this intermediate space where it shifts from goods into services, and now we're just looking at a whole new series of products that are going to be increasing with significant velocity, to your point. And that is the question in the next year and a half. That's a very good point. And the Fed wants us to now coast down gradually and decelerate, and not maybe decelerate, remove or reduce our acceleration, to your point. But we're seeing the economy is responding and prices are increasing in other areas now. Service sector. And that's alarming.
Is there a vicious positive feedback loop between companies posting record profits, pointing to inflation, and then raising their prices again?
This is a really good question. So yes, and so the hard part is that the limiting factor on this is whether or not companies can this whether or not companies can still make money selling X number of goods for some certain price, right? So at some level, companies want to increase their bottom line. I can double the price of something, but sell half the goods, maybe, if I have a very particular patent in a very particular good. It's not really that elastic, and it doesn't really work that way for every company. But there is a limit. As companies increase prices, people start cutting back. And then the question is then at what level do companies then sacrifice profits to keep prices stable so that they can, they're going to be tracking where consumer demand is and the appetite for consumption is. And they're going to be highly observant of this. And the consumers right now are getting closer to running out of gas in the last few months than we've seen. We had a huge amount of stimulus money. We had spending. Now we're seeing increases in credit card debt. That's a little bit alarming to me. We're seeing things that have remained low for a long period of time. We're seeing consumers starting to exhibit symptoms of stress. And when they exhibit symptoms of stress, they spend less money. And corporations can try to pass on higher profits to them, but they're going to hit a wall in the sense that they won't be able to deliver for investors higher profits because people won't be willing or able to spend more money on these goods. Thank you, Carolyn, for stopping by. It's so grateful. Thank you.
So let's use the oil and gas industry as an example, because that keeps coming up. BP Oil's been and Shell have been posting record profits for in like the last four decades. So how do they know when the sky's the limit? Because I don't think those of us that live in California can choose to not drive.
That's true. I mean, in this country,
if gas hit $10 per gallon, how do we get to say no?
So that's a good question. And the answer to that depends on the availability of substitute goods in certain markets. Gas, because in the United States, specifically in the United States in general, because we have everything from the culture of the country to the urban design of our cities, we have a very car-focused economy, period. So the average person is not equipped to, like, we can't build, So if you live in, I don't know, I'm trying to think of let's say you live in Little Rock, Arkansas, and you're looking to, gas prices shoot to $10 a gallon. There isn't public transportation that will take you from home to work, no matter how things happen. And even if you sell these things and move other places, you're looking at the urban design of a community that isn't equipped to handle large scale, the sort of large scale urban high density services that exist in other places across the world. And so we as a whole, we often do this. And so what happens is typically when gas prices rise, people stop spending money on other things. First with luxury goods and discretionary goods, and then to a level, it is possible to view gas uniquely in this country, not as a discretionary or optional good that people might use to spend on in other places, but it is actually a core, like it's a staple commodity in how we treat it. Like we buy toothpaste in the United States.
It's like a necessity.
It is a necessity. So because of this, we'll absorb higher prices on toothpaste. Eventually we'll start making our own out of whatever maybe there's I can find some sludge in but there's got to be a way to just, none of my allegories are hitting today. I'm sorry, I'm so tired. But you're absolutely right. So gas is a unique commodity because we lack substitutes in other places for transportation. People will cut back. They will look at urban areas in certain respects, and in certain areas you'll see a greater interest in living in places with those services. But for most people in the country, it's not an option for them, and so they'll pay it. And which is why we live in which is why it'd be very hard to imagine $20 a gallon gasoline in the United States being able to, within the same structural abilities, because it would disproportionately affect low-income populations. It would be very, very tough to see how we would emerge from that. So, like electric vehicles, they're happening, but the ratios.
Slow.
That's a generational shift. Yeah, it is. I mean, we're looking at PCs in 1982. Like it's a thing. Eventually, they will be. Everyone's going to own one, but it's going to take, it's going to take a while. So, That's what it is. That's cool. What else do we got? That's a really good point, Colin. I appreciate it.
Yeah.
What other
and I
questions?
guess I wanted to bring
Sure.
back, because before you hopped
Sure.
in, Albert, and I think you were there when we were discussing how stock compensation was being affected by the tumbling stock market. Do you have any more insights into that for our audience who might care?
This is really interesting. So like how they could more of the question of how they could structure their next negotiation and pay contracts. So if you're working for a publicly traded company and they offer you, I might not have been there. That's true. Sean points out, but I can talk about it. Oh, this is really interesting. And Joanna has a good question too. Joanna, it's good to see you again too. So, so regarding this question, when you look at this, equities are a good form of compensation in the long run, if only because it forces you to invest in the market. However, your mileage may vary depending on the corporation or organization you work for. If you work for an entity that's a larger or Fortune 500 company and the stock plans are well established and well benefited, you can continue to invest in them with a sizable portion of your income, even as stock prices go down, because your horizon is very long. It should be very long. Even if your vesting period is over and you're looking at, you still want to think about this in terms of decades, not in terms of individual assets. And if your company is going to be around that long, the average tenure of a company on the S&P 500 is about 30 years, because it often gets bought out by some other company. You'll end up making money in the end. So the way to think about this is think of the long term and don't get distracted by short-term stuff. Where it gets nervous and where I add that caveat in is you're working for most of your income comes from equity because you work for a startup, and your startup might have difficulty securing successive series financing to make sure that the company can exist in the future. And it might still be privately held, and you've gotten this award of equity within the company. This happened to my sister, actually. This is why this is very interesting. So she's like, well, we won't have any money to pay you, but we'll pay you in stock for our company that yet has to go public. So so she did this incredible 80-hour weeks for this company, and she was working so hard, and and she still hasn't been able to cash out. Hypothetically, she'll be able to, but in situations where capital is restricted, it might be impossible for your company to actually pay you, and they might fold. So that's the downside. John asks, is inflation really only 8%? I haven't bought anything other than grocery for a long time, and grocery prices, especially meat prices, has gone up at least 100%. In general, across the system, it is indeed 8.3% year on year, Joanna. But to your point, different sectors, particularly certain areas, especially meats in particular, have been beset by a very unique series of supply shocks that have forced their prices up even more so. Absolutely true. And it's hard to find. That's another thing. People can't adjust to it quickly. When people can't build something, develop something, or provide something from another source, you end up with shortages. And it's really interesting. So you're absolutely right, John. Certain subsectors of food have gone up much more than other subsectors. And I can get down into that a little bit more in the next time. Cool. All right. Those are good questions.
I guess my final question before I let everybody go eat or enjoy their evening is I think in one of our previous meetings, you said that the country is getting better at recovering from recessions, right? We're faster recoveries. Do you see that being true for the next one?
Oh, okay. So this was an important lesson, this pandemic. We recovered. We didn't do enough in the Great Recession. We probably did too much in this one. But before I get back to this, I'm not saying we did too much in general. I think that, there is a line to walk where we could have put a lot of money into people's pockets, and reduced a lot of those negative factors associated with the pandemic recession. But if we had sort of pulled off a little bit, we'd be seeing a better inflationary situation than we have. And this is the hard part. I think we'll never be able to effectively estimate what consumer demand will be following a recession. But I think it proves that a strong stimulus will be able to is more beneficial in helping us recover. too strong leads to inflation, and then this hurry up offense economic cycle where now we're talking about a recession having just recovered. And it's a fascinating dialogue. And if you look to the next instance, I think you're going to see policymakers be more careful around, I think they'll still be bold relative to all pre-2020 pandemic stimuli, meaning that if we compare everything governments did beginning it from 2009, 2008 in response to recessions, they're going to be bolder than that going forward, and that will improve the recovery time. But I think they'll be less bold than they were in 2020. And I think because we have achieved something which before the pandemic people were saying might not actually happen in our lifetimes again, and that's inflation. So I think they'll learn from the experience. I think we've been bitten hard by it, and I think it'll be somewhere in between where we don't recover as quickly, but we don't recover as slowly as we did in 2008. That's a really good question.
Okay, that gives us a lot to think about.
That does. No, I don't think. Yeah, I don't think the onus is there. The moral of the story is we don't have a blank check to write, an infinite amount of dollars in response to a recession because it results in inflation, and the economy can't absorb that in the right ways. I think we'll create smarter ways of boosting economic production quickly, but I think we're still learning.
Okay,
there's a whole bunch of things. The economy responded in ways that we could have gone back to the drawing board, and maybe that could do what we could have done. Could have been a whole subject session in this. We could have focused more energies over here on, say, supply chain issues and concerns, and less energies on other things. But then again, the pandemic we had supply chain shortages because the news was bad, and companies cut back on their production as soon as March and April of 2020 rolled around, not anticipating consumer demand would bounce back. And so I actually think companies will be smarter in the future, having observed this. And when they see a recession, they'll be like, let me wait on this. I'm going to see how this pans out, and I'll try to maintain maybe more capacity so we can recover quicker. Oh gosh, Carla, thank you so much, Carla. That is so nice of you. Thank you so much. It makes my day. Hearing from all of you is a wonderful thing, and you guys were so patient to sit through this. So thank you so much. I love talking to you all.
Yes.
If you're a class, A+ is for everybody. A- for Colin.
I think that's it. I don't think anybody dropped questions into the chat or Q&A section. So thank you everyone for attending tonight's webinar. We hope that with this information, you feel a little more informed about what's going on in the jobs market, what's going on with inflation, and how to hopefully prepare for whatever is to come for the next few months or a few quarters. I've dropped a link there in the chat for other Albert's List webinars. And if you're interested, most of them are free. Please feel free to hop in and join. We will be hosting this very same webinar again in June to discuss May's issue and whatever the inflation is at that time. And in the meantime, have a wonderful night, and I hope you have a wonderful May. Good night.